Interest rates are on the rise and the SBA landscape is shifting once again. Hey, at least we're not bored, right? Think about it. When I came into SBA lending in 2011, we were pulling ourselves out of a pretty deep recession, and each year was slightly better than the last. I think prime was 3.25% for like 6 years straight. And finally, things started heating up in like 2016, and by 2018, 2019, the economy was red hot, and prime had risen as high as 5.5%. Which is still relatively low. For some reason, Fed lowered rates back down in 2019. I think prime was 4.75% when COVID hit. And then within 15 days, they lowered it back down to 3.25%, where it has sat until now. Now we're on the move again, only this time, instead of a red hot economy, we're facing a potential recession. These are uncharted waters, and as small business lenders, we need to make sure we're going about this the right way. So let's break it down. Before we look forward, we have to look backwards. Rates have been historically low forever. If you're a 7A lender and you price your deals at prime plus 2.75%, the highest the rate was over the last decade was 8.25%, and it was only there for like 2 quarters. That's low. Here's a fact. Fed has basically kept 0% rates 9 out of the last 13 years. That's because there were no signs of inflation. Remember those days? Good times. Now there's tons of inflation. Small business owners have had to deal with a ton of adversity over the last 2 years, and that doesn't appear to be changing anytime soon. Supply chain issues, shipping costs increased, shipping takes longer, so small business owners are buying inventory sooner and buying it in bulk, which ties up cash. You can't even get certain products. Hiring people is harder, you have to pay them more. The list goes on, and these headwinds have resulted in small business owners having to increase their pricing. And interest expense on an SBA loan is no different. It's just one more thing that's more expensive. But the key is adjusting for these things and planning. And some small business owners are really hesitant to raise prices because their customers are so price sensitive, but they have to. The way we go about this as underwriters is by just asking the question. Just like we did with COVID, just like we did with supply chain, interest rates are going up. What's your plan? As SBA lenders, we underwrite debt service coverage. So let's say you have 1.15 debt service coverage for 1 year. 6 months later, depending on how fast they raise rates, that same business could be closer to 1-to-1 or even below. Now, in the cash flow analysis, the underwriter typically performs a stress test on the interest rate, usually about 2% higher, just to see what it would look like. And we haven't paid too much attention to that for the last decade, but now it's more relevant, a lot more relevant. And if a business is at 1.15 for the last 3 years and revenue is flat, and they just want to buy their building with 100% financing with a floating rate 7A loan, at some point, they're not going to be able to afford that debt if they don't increase their prices. So what's their plan? As lenders, we have to be taking this consultative approach with the borrowers, making sure that they're thinking about these things. Now, ideally, you're making a loan that's going to allow the business to grow the top line in some way, whether it's an expansion or even a business acquisition with a new buyer. And historically, if a deal cash flowed, I didn't focus on the projections as hard as I would a projection-based deal, but now projections are going to be a lot more relevant. Enough about the underwriting side. Let's now talk about the sales side. As you know, most SBA 7A loans have floating rates. With the rising rates on the horizon, of course, every business is going to ask the question, can I get a fixed rate? Now, rates are still super low, and even if rates went up 2%, they'd still be considered low. But this abrupt shift from an environment where rates haven't moved for 2 years to multiple projected rate hikes, it's going to cause some commotion in the marketplace. So if you're like me and all you make is variable rate 7A loans, how do you sell the variable rate? Well, the answer is you don't. I don't sell rate. I never sold rate. The interest rate is one of about 100 aspects of SBA financing. So what are you really selling? Now more than ever, is it necessary for you to really understand what it is you're selling to the market and to double down on that? Because if you're a highly paid BDO, complaining that you can't sell your product is not a good look. This is where a deep knowledge of the market is critical. You need to understand your strengths and your competitors' weaknesses. Let's say you're financing a business acquisition and you're up against a 3-year fixed rate. All right, first of all, let's put a dollar amount on it. If you're borrowing $1 million and rates do go up, let's say, 2% over the next 2 years, that might be a savings of, let's say, $45,000 of interest over the course of those 3 years. $15,000 a year on average, let's say. And that's substantial, right? Well, what's the trade-off? Number one, maybe they're requiring 15% down instead of your 10% down. What's an extra $50K in the bank worth? That money isn't just going to sit there. At a minimum, you'll put it in a brokerage account getting 5 to 10% return. Higher if you put it into Dogecoin. I'm kidding. What if a second acquisition comes along and you don't have enough cash because you put all your cash in the first deal? Saving a few bucks on interest is peanuts compared to the ROI you'd get on rolling up a second business into your existing business. Maybe you can provide more working capital than the fixed rate lender. That could be used to hire more employees, which in turn can grow the business and I'm guessing produce a much higher ROI than a 1% interest rate increase. What about execution? I don't know if this is a popular opinion, but my take is if a lender is essentially cutting their profit by fixing the interest rate, how can they afford to hire the industry's top talent and enough underwriters and closers to ensure that they have the capacity and bandwidth for all these small business owners that are going to come flocking to their fixed interest rate? Because if it takes too long to close your loan and it's an acquisition or a real estate purchase and the seller gets tired and walks, the borrower's toast and their interest rate is zero because there is no loan at that point. There's no building. There's no business. Execution is key. Don't let that be understated. And I'm just trying to get your mind working in a different way so that you're not chasing your tail trying to be something that you're not. And by the way, if you're a fixed rate lender, lean into that. Getting deals in the door is going to be easier than ever these next few months at least. Your challenge is probably going to be more so getting the deals approved and getting good quality deals. Now, the good news is I think conventional lending remains scarce, and that's when SBA comes in and fills in the gaps. So we're going to be seeing some higher quality deals we wouldn't normally see. And so I think we're poised to have a couple of really strong years. All right, that's it for this week. Don't forget to subscribe to the podcast so you never miss an episode of The Art of SBA Lending. And if you have any feedback or suggestions, email me at ray@artofsba.com. Until next time, ta-ta.